Thanks, Gordon. So up next, it's hard to imagine being here today at such a busy IPEM, but less than 12 months ago, Europe was still in the grip of lockdowns, and the next session will consider how the pandemic experience has really equipped the private equity industry to weather these challenges ahead. In the early onset, of course, fundraising and deal activity barely blinked, but the new normal may be a bit more challenging. So I'd like to invite Sunaina to the stage with her panelists to discuss what private equity has added to its toolkit from the experience of the past couple of years. Sunaina.
Thank you, Matt, and thank you, everyone, for coming and listening to us. We'll try to keep it engaging and dynamic and also add a little bit of value to you here today. So I'll ask my fellow esteemed panelists to please introduce themselves and tell us a few words about what they do and their organizations. Richard, would you like to start?
Yeah, thank you, Sunaina. Hello, my name's Richard Hope. I'm head of EMEA at Hamilton Lane. IC member, exec group member. I principally spend my investment time sitting in our secondary business, but obviously as a broader organization, we invest across the whole asset class. So nice to meet you all today.
Hi, everyone. My name is David Morin. I'm with PSP Investments. So we're one of the Canadian pension plan. Started in Montreal in the PE team. I've been with the team for about 9 years, and recently moved over to London to run the European private equity business. So it's a mix of co-invest and fund investments.
Bonjour, I'm Jonathan Zafrani. I've been with Carlyle for 23 years, and I'm co-heading the European buyout team, which is our mid to large cap PE strategy in Europe.
And I'll be moderating today's panel. I'm Sunaina Sinha. I'm the Global Head of Private Capital Advisory at Raymond James. Raymond James Cebile works in placements and secondaries. So let's dive straight in. We're living in a new normal. We've come through a pandemic and seem to be lurching into the next crises facing us. But before we talk about what we're dealing with today, let's do a look back as to where we've come from. Richard, we'd like to start with you and tell us, what does this new normal look like for you and the GPs you invest in and the landscape at large? What have we learned from the pandemic and are applying today?
Thank you, Sunaina. So maybe first I'll start with scale. So we came into this year as an asset class with $6 trillion of NAV, $2 trillion of unfunded. Never has the industry been bigger. And so I think as we think about, that's why we're here, as we think about that, investors in the broader universe are thinking about the attraction of private markets. The second is performance. And so performance has done extremely well through 21. And as we came into the start of the year, for many that was creating a numerator challenge. All of your portfolios look better than they've ever done. And as we've come through the year, that's developed somewhat into a denominator challenge. And I'm sure we'll come back to that later. And the third thing and the most important thing is transparency. And so as we all lived the COVID nightmare 2.5 years ago, what we learned was the ability to all communicate with each other off cycle. So once upon a time, you could only get information quarterly or semi-annually. But I think today, what happens is we're all much more readily able to share information and also receive information. So for me, that's a big positive, Sunaina.
David, tell us about PSP. As you think about your portfolio, what has that evolution through the pandemic been? Are you looking at new ways of working with GPs that are here to stay?
So we have a fiscal year that ends sort of end of March. And so when you rewind back to sort of April 1st, 2021, our portfolio was about 30 billion. So this was, call it, 15% of total PSP's AUM. And if you look at the next 12 months, which were basically like the COVID months, we realized, or we were able to get back about 10 or 11 billion of capital through either commitments that we got back from our GPs or from dispositions of sort of direct position that we own. We generated another 10 billion of investment income. Now those are in large part paper gains because we marked to market. And then we also deployed. And so we went from 30 to 36. But if you look at the numbers, they're quite large numbers. So I think it's been a bit of a crazy year, to be honest. We also saw deal velocity go up quite a bit. So for anyone that's worked on a deal, scheduling a management presentation is quite a task for sell-side bankers. But during the COVID times, they were able to schedule twice a day or maybe 3 times a day sometimes. So I think we saw everybody thought that everything was going to pause, but in reality, what we saw is sort of deal velocity sort of increased quite a bit. And so for us, it was a pretty big acceleration of kind of the deals that we were looking at, and also getting inbounds from some of our GPs that were looking for co-invest.
And Jonathan, you undoubtedly saw this acceleration in the pace at which you were looking and looking through and cycling through deal volume. How does that portend to where you're at today? Has that deployment pace and that velocity decreased as a result of the last 9 months?
Well, actually, at Carlyle in Europe, we've always had the policy of keeping a very diversified approach to investing, and that includes vintage diversification. So we've continued to invest with the normal pace, throughout COVID and in the recent years. So we've not accelerated our pace of investment. We've accelerated our pace of exits, obviously, because we've tried to benefit from the good exit environment. And in terms of looking at deals and velocity of due diligence, I agree that effectively, all these management presentations by Zoom, etc., have made it easier and faster to do due diligence. When actually in the midst of the pandemic, we're looking at deals, and we had that call with all the senior partners at Carlyle, and decided actually what are we going to change and not change in terms of looking at the deals. And one of the decisions we took at the time was we're not going to invest in a business if we don't meet physically the management team. So even during COVID, we said, okay, this is a red line for us. And now, frankly, we're talking about the new normal. When I look at today, the number of people present here, it doesn't feel like the new normal is very different versus the old normal.
Richard, I want to talk about capital in motion. It's something that my group and I think about all the time, right? As US and Europe are reeling from macro headwinds, you do have parts of the market that are leaning into private equity while others lean out. Talking about private wealth, talking about Middle Eastern investors, any investors with an oil or energy beta that's helping them with cash flow. How do you think about Hamilton Lane's own fundraising, and when you look through to GPs in your portfolio as they fundraise, where do you think the new flows into our asset class will come from?
Yeah, so good question, and clearly the one everyone's trying to answer. Maybe first just what's going on. So right now we have a slowing of liquidity. Last year, never more realizations. You've heard this already from my panelists. So I think last year 1.2 trillion was drawn from the market, but 1.6 trillion was realized. And so huge amount of capital. So the industry was net cash flow positive. Never have more funds raised, never has more money been sought in the marketplace. And that's creating a challenge for the LP. That liquidity constraint is, yes, I might have had a lot of distributions, but actually I've got ever more people asking me for money. And so that's forcing decisions. Do I go slower? Do I re-up later? Do I not re-up at all? And so that presents its own challenges. In terms of then where to find the money or how to find the money, it's opening up new avenues. Sunaina, you said it yourself, the Middle East. No surprise if you're in the Four Seasons in Abu Dhabi, you see much the same audience as you do here. Or if you're running around the private wealth managers, the private banks, all trying to think about how to access the asset class. I think for some investors, they're out just now. For others, they're trying to keep going in the marketplace. And so they're trying to find liquidity. So is that through a secondary? Is it through some sort of deferred commitment? We're seeing and hearing all of these things in the marketplace right now. But I think as you raise capital and you look for capital, it's being creative. I think probably the biggest forgotten piece from the last 12 months, if you go back and look through last year, was everyone's performed and everyone's performing really well. And so you may have your own best performance that you've ever had in your history, and then it's a real puzzle with your partner group. Well, why is my fundraising slow? Why am I not raising at the same speed or velocity, you mentioned, Sinha, of that capital that we've seen in the past? And it's just because of the number of asks, and that's very telling. And so I think being aware of actually what else is out there, we all live in our own little vacuum, but actually looking across the industry in a broad enough way is important.
Thank you for that. And let's now talk about what that means for GP deployment. Jonathan, if we can defer back to you on the GP side of the equation, and of course, keeping in mind that both PSP and Hamilton Lane also have great relevant experience here. I'd like to talk about today. Are you slowing down the pace of deployment? Is what's happening around us with inflation and with the energy crisis changing the underwriting of investments for you? What risks are you underwriting to? Jonathan, kick us off here and help us think about what you guys as a partnership are doing differently given the headwinds facing us.
Okay. Well, I mean, first of all, when I look at the actual performance of our portfolio, up until the end of Q3 this year, it's actually very solid. I have the feeling that most companies actually, pass through, or at least in our portfolio, pass through the inflation in their prices at the end of last year and beginning of this year, probably also hedged smartly energy. So for 22, I'm not so concerned. Obviously, I mean, there's more uncertainty for 23. And I mean, that uncertainty, notably when it comes to energy, is difficult to price. So, I mean, simply what we do is we try to reduce the uncertainty. There are certain known facts that we can price. There is less debt available, interest rates are increasing, the margins are increasing. This you can price in your model. An uncertainty with a very wide range of outcome is very difficult to price, and so we try to shy away from those deals. Now, we have, I mean, many deals going through committee. The reality is we bake into our plans, recession, probabilities for next year, higher cost of debt, less cash flow, which means that de facto valuations are coming down. Now it's difficult to transact because as buyers, we probably react faster and adjust faster than sellers. And so it's going to take, I think, a few months and probably also the reopening of the leverage market to get much more deal activity than what we see now.
David, is PSP more cautious in its standing with respect to underwriting, and has the investment process shifted?
Nothing's really changed. I mean, we've always been investing out of our own balance sheet, and we don't need to invest. And on the other hand, we can hold for a very, very long period of time. There's a couple of investments in our portfolio that we've owned for, 8+ years, and we think we'd want to own them for another 10. So we have the luxury, by our nature, of not having to transact on a constant basis and be quite opportunistic with the way sort of we time sort of the ups and downs of the market. So nothing's really changed. We've always had that approach. There were some years where we ramped up the program. When I came into PSP in 2013, PE was a 7 billion Canadian asset class. It's now a $36 billion asset class. So clearly things have changed, but we underwrite risk pretty much the same way. I think there's higher scrutiny on sort of execution risk and whether we'll be able to get those deals financed. And for that, we have the luxury of having a pretty solid credit investment arm that, several members of that team actually sit on our PE committee. So we have this constant battle around sort of what is doable, what is not doable. And I think that gives us a good read into the market. So not much has changed, I will say. But clearly the parameters need to be flexed.
Richard, let's talk about the secondaries market for a second, because Hamilton has great expertise, and you do personally and professionally too. The bid-ask spread has been quite wide there when it comes to LP transactions. As you think about the rest of the year, are we going to go back to the market volume that we achieved in 2021, or are we going to be shy of that just given some of the friction to transact these days, back to the execution risk point?
Sure. So maybe give you some numbers. So last year as a business, we saw 209 billion of deal flow. That's roughly the market. And as most of you maybe know, 130 billion transacted. As we've come into this year, deal flow is significantly up, I think about 40% up. So if I look at my CRM, I think we have 180 billion of deals through to this point. And so huge explosion of opportunity. There's been a shift though. So last year was roughly 60-40 in favor of the GP-led or the continuation vehicle. This year it's the other way around. And so actually 60% LP deals and 40% GP-led. And so opportunity set is up, but actually it's more people looking for liquidity to ease some form of stress that they may have within their LP portfolio. Q4 has always been the biggest quarter. We're not there yet, but yet we've got record levels of deal flow. And so as we think about the bid-ask spread, that has broadened, and it's broadened because of basic demand and supply. And so as a seller, you can find liquidity in the market, but it may not be a price that you like. And so we're talking for very high quality funds, pricing today in the 70s and 80s. And certainly, as I look at what we've invested in recent times, we just haven't seen those pricing. But yet still, price isn't the only thing. We need to make gains out of the post-purchase appreciation. And in an environment where, you've heard it from my fellow panelists, there's more concerns, more macro issues and higher interest rates, then actually you still have to be careful not only about the discount that you find on the way in, but actually what's going to happen with that portfolio on the way through.
Yeah, maybe just one additional comment. I think we as an industry have a tendency to overreact. When everything goes well, we have great business plans and great exit multiples, in our models. When things are uncertain, we are very cautious. We tend to forecast the worst outcome possible. And I think what that means is next year, there will be great deals that are going to be done. And I'm pretty sure that when we look back, in 5 or 6 years, it's going to be exactly the same as what happened for the deals that were done in just after the great financial crisis. There were fantastic deals done at that time because some people were able to look through the uncertainty and take appropriate risks and have, the necessary execution power, in-house forces to drive changes at those portfolio companies. So I think it's going to be great to invest in the next 18 months.
Thank you. David, I want to double click into something you mentioned a little bit earlier, and Richard and I were having this conversation at lunch, which is credit worthy. How do you credit finance some of these deals, especially at the larger end of the market? Let's talk about Europe, because Europe has a very different dynamic to the US market when it comes to the financing of leveraged buyouts. How are you viewing the European opportunity set, especially at the larger end, given the fact that you've had a little bit of a sit-out period for some of the bank lenders?
I'm probably not the best person to answer that question because I'm not part of the credit team, but it's been a challenge. I think what we're going through right now has shown that the depth of the European credit market, in my humble view, is not as deep as maybe we thought it was, or at least like my fellow panelists said, we tend to react quite heavily when things happen. So our credit team has been quite busy, looking at a number of things and getting inbounds from a number of sponsors that are trying to execute on those sort of good, risk-adjusted opportunities that we're still seeing in the market. But I think, the ultimate thing is, I think for solid deal making and sort of good volumes to come back, I think the bank market needs to come back. I think the direct lenders in Europe in particular can be helpful, and we've seen a lot of players sort of help out recently. But I think we're going to have to see more of the traditional banks coming back. Otherwise, we're going to be in for a rough next 6 months.
Jonathan?
Yeah, I think there is no way the private credit can replace the banks. The leverage loan market. I think if you look today at, what is available in Europe, I think you probably have, the dry powder for private equity is probably 3 times, what you have available in private credit. So, it should be maybe, I don't know, the equivalent to make it work, assuming, funds are deployed at the same pace. So, we have no choice today but go into private credit. They are very selective. Sometimes I think, the terms and the non-financial terms are very onerous. And so it raises other questions when it comes to risk, etc. But, we need a functioning leverage loan market.
Absolutely. Please, Richard, what are you seeing with your sponsors?
Yeah, so maybe something here. I think North America's had a very different rate environment to Europe. And so Europe, we're only moving from negative to neutral in large parts of Europe. And I think that's caused a hindrance on the development of the direct credit market in Europe. And so here, we have a much smaller market that hasn't developed in a way that's actually rewarded people for the risk they're taking on the debt side. And so as the equity in Europe has been raised in significant quantum, the debt hasn't been raised in the same quantum. And so there you have the imbalance. If banks are out of the market, then where do you go to lend? And the pricing on that debt has become unpalatable. And so I think at some point we'll move back into an equilibrium. But for now, what we're hearing and what we've seen through the summer is very hard to do deals, particularly at the larger end. I think much of the audience here this week is maybe more lower mid-market or mid-market. It may be somewhat easier to finance with the banks, a single banks or a small number of banks. But as you creep up the deal scale, certainly the raising of that capital is more challenging and costs you an awful lot more than it used to.
Let's talk about inflation, because we haven't spent enough time on that, and we should. Almost every GP I have met in the last 6 months has said, well, inflation, not a problem. My business passes through the price increases. Nobody has said anything differently. What point does the music stop on that and you start seeing EBITDA margin erosion, which is inevitable? You're starting to see it in the public EPS releases, and you'll see it in the private markets. Where does that start to bite? David, do you want to kick us off?
No, I think it's going to take some time. I think, the business we're seeing have started pushing price, for over a year now, and if not even more. But there's no immediate reaction to that from a customer perspective. So, some of the comments we see sometimes is, hey, we've been able to push, 10, 12% of, price increases, no reaction so far. But it really takes like a few quarters before you have management teams on the other side of the equation as, the client looking at, their situation and thinking how to find their own solutions. So I don't know when the music is going to stop, but I think we're in for a ride, because we're going to have to keep on, pushing those costs up, across portfolio companies. And there comes a point where, the model might break a little bit. So I think we're going to see reduction in EBITDA margins across the board. I think we're already seeing it to a certain extent. And obviously the businesses that have the ability to pass on these, will be the most attractive ones, of course, but we need to find them. And I think they're going to get priced as such as well.
Jonathan, are there certain sectors you as an investor are leaning out of with respect to this environment? For example, consumer discretionary.
Yeah, I think it's pretty clear that it's not that we're leaning out, but we're favoring other sectors. And clearly, we have a relatively diversified portfolio. We play, big in consumer, but notably on, the higher end of the segment. Luxury and affordable luxury. So we're a little bit less sensitive to what's happening now in terms of inflation. But clearly, a new deal in consumer, is going to be more scrutinized than a deal in healthcare or a deal, that is benefiting from the fundamental tailwinds, behind energy transition, climate change, sustainability. So clearly, we're trying to avoid businesses that are going to be impacted heavily by, the repercussion of the inflation on the purchasing power, and also, businesses that are big consumers of energy today.
Richard, we also should spend some time on energy crisis, right? You've got a situation that's pretty unique and exacerbated here in Europe. At the same time, where we as an industry have made a real thrust towards ESG and the importance, especially, of being environmentally friendly in our businesses. We have macro headwinds blowing at us that are threatening to reverse some of those changes. How do you, as a major LP and also a direct investor, think about the importance of climate change and ESG in your portfolios?
So we think heavily of climate change and ESG in the portfolio. Clearly, none of us can control the generation of electricity and the generation of energy. And so I think we're in a difficult spot in the next 3 to 6 months, but that's not unique to the industry. And so I think to the industry, it's continue doing what you're doing, improve standards and raise the bar there. I think particularly with SFDR, the carbon and the emissions data that we're all required to record and share is going to be critical. And so as we look at the regulation and the regulatory environment we live in, there's going to be an awful lot more to do there, Sunaina.
Thank you. And David, talk to us a little bit about how you're going to think about your mix going forward with respect to the energy element. Are you going to think about certain deals are carved in or out because of climate change and ESG governance, or does nothing change in respect to that ESG remains important, but the energy crisis doesn't shift the investment thesis?
Yeah, we've spent quite a bit of time over the past months sort of thinking through our ESG strategy. And I think what's coming out is that the portion of the market that we're going to try to stay like really away from is actually quite small. So we're not going to shy away from these sort of kind of mid-level assets, because there's a view that PSP, as their position and as a large LP in a big ecosystem, we want to use our influence to improve things, okay, which is noble. But in reality, if we only pick the green assets and only favor the ones that already have a great track record from an ESG perspective, because you can look at it from a climate perspective, but also from an ESG perspective, I don't think we're doing the right things. So I think we've selected to opt for a larger opportunity set, but ESG is becoming a real part of our investment criteria. And it's always been, but it's now a more upfront question that we have on our ICs. And so I think we're going to see a lot more. And I think we're also trying to use our influence with the GPs that we deal with, because from where we sit, we see the great ones and the less great ones, right? And so our ability to kind of use the data that we have and the frameworks that actually we think are the best, and to influence some of our other partners in implementing those, I think that's part of what we're trying to do as well.
We have a couple minutes left. Let's go to the future. Can each of you please give us your big, hairy, bold prediction for the next 12 months? What will we look back on for an IPEM 2023 and say, hey, you guys were right? Jonathan, do you want to kick us off?
Management fees are going to be indexed with inflation.
Bold.
I'm surprised you don't have a standing ovation to that one.
That's pretty bold. No, I think nothing too bold. I think in Europe we're going to see deal activity kind of. I think it's going to be pretty much shut down until Christmas. I'm not, I don't have a crystal ball, but the way things are going, you look at the pound, the way it's sort of reacting to the U.S. dollar and change in interest rates in the U.S. I think there's going to be sort of a higher cost of debt, and I think ultimately that's going to make deal making a bit more difficult. For how long, I don't know. I know that's not super bold, but that's all I could find.
Richard?
So 3 quick things. The winter will be ugly. I think we've all heard that it's going to be driven by consumer sentiment. But then the reality of opportunity is also going to set in. Secondary market will be bigger and stronger than ever. You've already heard the deal flow. And then on the credit market's just got to catch up. And so as the interest rate environment rises, what that's going to do is it's going to bring investors into that part of the asset class, which will sustain the rest of the industry for the longer term.
And from my side, the average period to fundraise for any GP is going to go up from about 15 months to 19 to 20 months, if not longer. So with that cheery note, we're on time. Thank you, everyone, for listening, and we look forward to catching up later. Thank you.
Thank you.